Ladies and gentlemen, welcome back. We have just found out that the New York Stock Exchange has been hacked. And this is not an exaggeration. This is not clickbait. This is literally the New York Stock Exchange has been hacked, along with several of their subsidiaries, which is massive news with incredibly vast implications for billions of retail traders. This is bad news. And we're going to go over exactly what happened here. But guess what? The worst part is their parent company didn't even tell the SEC or FINRA. I can't believe it. We're going to give everyone a quick second just to jump in the chat here because this is a live stream. I didn't inform anybody of it. So let's just give everybody, 30 seconds to hop in here in the channel. What's going on? Diamond Hand, Zachary, Paul, Jeffrey, Black Widow. Ladies and gentlemen, welcome to the stream. Welcome back. This news is so bright, I have to put my sunglasses on. This is massive, massive. And what a coincidence as well. But we just found out today that there was non-compliance with timely disclosure requirements after this event occurred. So it's not just an isolated event. This is something that's should have been revealed. It should have been explained long ago. Let's take a look at the data. Doug asks if they're going to use this as an excuse to deny the CAT system. I don't believe so because the consolidated audit trail is already being implemented. Thank the Lord, because retail needs the consolidated audit trail in order to cut back on the naked shorts and really help stop and deter a lot of the stock market manipulation that's been going on for years. Some of you may know that may or may not know that at the beginning of this month, the Securities Exchange Commission actually managed to work with the Department of Justice and put some people in jail for some stock market manipulation. So huge shout out to the DOJ and the SEC for finally using the consolidated audit trail that was originally implemented back in 2010 after the GFC. But yeah, take a look at this. Let's jump right into it, guys. Let's not waste any time now that you guys are here. ICE, the Intercontinental Exchange, that is the parent company of the New York Stock Exchange and 9 wholly owned subsidiaries, has been fined by the Securities and Exchange Commission. ICE agreed to pay a $10 million penalty. $10 million penalty for failing to report a cyber intrusion as required by the regulation SCI, the Systems Compliance and Integrity. So according to the SEC, a third party informed ICE that ICE was potentially impacted by a system intrusion involving a previously unknown vulnerability in their VPN. So ICE, again, the Intercontinental Exchange, the parent company of the New York Stock Exchange, investigated and was immediately able to determine that a threat actor had inserted malicious code into a VPN device used to remotely access their corporate network. However, the SEC has found that ICE personnel did not notify legal and compliance officials at the ICE subsidiaries of the intrusion for multiple days, which is a huge violation of their own internal cyber incident reporting procedures. So as a result of these failures, those subsidiaries did not properly assess and stop the intrusion to fulfill their independent regulatory disclosure obligations under Regulation SCI, which required them to immediately contact the Securities Exchange Commission staff about this hack and provide an update within 24 hours unless they immediately concluded, or estimated that it had or would have no impact on their operations or market participants. So, the Intercontinental Exchange and the 9 subsidiaries, the parent company of the New York Stock Exchange, consented to the entry of the SEC's order finding that their subsidiaries had all violated the notification provisions of these regulations and that ICE caused those violations. And of course, without admitting or denying these findings and their subsidiaries, which consist of Archipelago Trading, the New York Stock Exchange, New York Stock Exchange American LLC, New York Stock Exchange ARCA, ICE Clear Credit, ICE Clear Europe, New York Stock Exchange Chicago, New York Stock Exchange National, and the Securities Industry Automation Corporation agreed to a cease and desist order in addition to ICE's monetary penalty of $10 million. Imagine those peanuts. $10 million in peanuts here. The ICE agreed to pay that to settle charges caused by nine wholly owned subsidiaries, including the New York Stock Exchange, through a cyber threat, an actual hacking of the New York Stock Exchange. Now, the actual hack itself happened in the past, a couple years ago. But the fact that they're finally catching up to what happened just shows you just what kind of a risk our country is in and our financial markets are in. And this is something that continues to happen. This just happened yesterday. CGML, Citigroup, was hit with a fine for a trading error consisting of over 444 billion US dollars. So there were multiple deficiencies and human error that occurred at Citigroup. And what happened here was due to a poor state of its trading controls and the lack of internal regulation by their own compliance and internal risk functions, flagging their unsatisfactory states, a number of incidents, audits, and compliance reviews beginning all the way in 2018 found that there was persistent weaknesses, and it culminated in a serious equity trading incident. And this led to the imposition of a fine of $43 million by the PRA and an additional $35 million by the FCA. These are European and UK banking and financial regulators. So the incident took place on a bank holiday Monday in the United Kingdom when a trader who intended to sell $58 million basket of equities used the wrong input field and accidentally loaded this basket with not $58 million of equities, but they loaded the basket with an order of $444 billion with a B as in bitch, comprising 349 stocks across multiple European markets. This immediately generated 711 warning messages. Not one, not two, not three, but 711 warning messages in the system. And these were listed in a single alert with only the first 18 lines visible to the trader, who had to scroll down to review the remaining 711 warnings. And they included 2 hard block warnings, which could not be overridden, and those stopped 248 of the $444 billion worth of equities in the basket from moving to execution. However, as you can see here, it did not stop anywhere near enough of the execution here on this. Let me scoot this thing over here. My bad. This is hilarious and sad all at the same time. Citigroup got fined. If you just joined, I saw your text, your message there in the comments. So, despite being presented with a notional value of $196 billion worth of equities in this basket of equities in the final pop-up, the trader pressed OK and executed the remainder of the friggin' order. Holy shit. So 7 orders were blocked by Citigroup's controls, which reduced the basket size to $189 billion measly dollars. The remainder were sent to be executed, sliced, and scheduled for trading over the rest of the day. And additional controls operated as expected, reducing the basket further to $24.6 billion. And regardless of this ridiculous lack of regulation, internal regulation by Citigroup, there was still over $1.4 billion worth of sell orders that were executed, leading to a drop in multiple European indices. So approximately 10 minutes after hitting the OK button, this trader found their error and after several attempts succeeded in canceling this ridiculously large $444 billion order. So the monitoring desks entirely missed this issue, and for because of that, it tanked multiple European indexes, and it was a bank holiday, and their bank's algorithmic service desk responsible for monitoring the internal executions was not even staffed. There was nobody in the frickin' office. Not a single person was there because it was a holiday. And who are the victims here? Pension funds, 401ks, day traders, retail investors, thrift savings plans, IRAs. So I'll leave this at that. Let's move on here because we have other fish to fry. But yeah, Citigroup got a $10 million slap on the wrist for a lack of risk controls that led to a $444 billion fucking trading error. Not to mention, just a few days ago in Hong Kong, multiple brokers were put in jail for 3 months for falsifying trades, for false trading. Why don't we have this in America? Why doesn't this happen in the United States yet? Why are these guys just given a slap on the wrist instead of actually being put in jail like other countries are actually doing? We need this here in the United States. Maybe that would be sufficient to stop these guys from committing all these white collar crimes. So the Eastern Magistrates Court of Hong Kong sentenced two former traders to prison of 3 months, which I know doesn't seem like a long time, but they also got other fines as well. They got imprisoned for 3 months each following their conviction for false trading in the shares of a company called Forbase International Holdings. And so the magistrate said that these two traders played important roles in the false trading of Forbase shares in their capacity as licensed brokers. So a period of over 10 months, these guys created false and misleading appearances of active trading, which were not the case. So having taken into account the serious nature of their offense and the need to protect the retail investing public, the magistrate concluded that the immediate custodial sentence of 3 months was appropriate in the circumstances of this case, which I'm glad that they at least went to prison for a period of time, but the magistrate said they will not tolerate licensed persons abusing their positions to engage in market misconduct and manipulation, and we will not hesitate to take actions against them because of these serious wrongdoings. The licensed person should always keep in mind that they are expected to uphold high standards of conduct and to act in the best interest of clients and the integrity of the market. Why isn't this happening in the United States of America every single day? Because we have time after time found that this is the same thing that are happening here. And oh, look at this. The SEC has just charged another proprietary trading firm with this exact thing. So this proprietary trading firm, Kersner Trading Americas, has been found just the day before yesterday to be violating trading rules. The SEC announced charges against this Austin, Texas-based high-frequency trading firm called Kersner Trading Americas for violating an SEC trading rule by purchasing stock in 23 separate public offerings after selling short the same stock. So they went short the stock. That means they sold the stock without owning it. They sold it without owning a single frickin' share. And they hadn't borrowed a single share. This is called naked short selling. And then they purchased stock in those 23 IPOs when it was prohibited to do so. So they violated Rule 105 of Regulation M under the Securities Exchange Act, Rule 1934, prohibiting naked shorting of an equity during a restricted period, which is the 5 business days before a covered public offering, and then purchasing the same security in the offering, absent an exception. So this, regardless of their trader's intent, this was designed to prevent manipulative naked shorting and short selling before the price of covered offerings actually occurs. Why aren't these guys put in jail? So, of course, without admitting or denying the findings, Kersner agreed to cease and desist and took a little slap on the wrist and agreed to pay a measly $812,000. So they naked shorted and then bought back shares illegally, 23 separate initial public offerings on the New York Stock Exchange, and took a slap on the wrist without admitting or denying the findings, and then agreed to a cease and desist. $812,000. Meanwhile, people in Hong Kong, people in overseas, people in Vietnam and Taiwan and Thailand, everywhere basically, are being put in prison for the same things that here in America, guys are simply getting a slap on the wrist for. This shit needs to change, hence why we're creating a new broker-dealer by the name of Lit Exchange to help quell some of the manipulation, to help stop this from happening and protect retail traders from this market manipulation. It's fucking ridiculous. And of course, we are for retail, created by retail, and we are coming soon. FCA has charged an additional $8 million in a pension fraud scandal involving CFDs. Now, you may not know this, but CFDs are used in multitudes of different equities. So the United Kingdom Financial Conduct Authority charged 3 people with fraud for their alleged involvement in a high-risk trading scheme. And this targeted people's pension savings. Yours, your parents, your grandparents' pensions are at risk. Teachers, firefighters, police officers were defrauded here. And they have been charged, and I'm going to name them. Christopher Maguire, Keith Williamson, and Carla Walker of the UK were charged with multiple offenses, including fraud by false representation and fraudulent trading after they targeted victims by persuading them to invest in contracts for differences. This is what CFD stands for, contracts for difference. And if you are invested in things like silver and gold and AMC and GameStop and other highly shorted companies, if you were ever invested in Volkswagen and dry ships, etc., you'd be well aware of what contracts for difference are. And many victims of the alleged fraud were encouraged to use their pension to invest, which were then traded to generate large commissions for those running this scheme, which the victims' pensions funds almost entirely lost. They were almost entirely wiped out. 100% of realized losses at this point by the victims of this pension fund scheme. So the FCA from the UK alleges that these 3 assholes, Maguire, Williamson, and Walker, made false statements to a trading platform to their clients that their clients were professional investors. So they're being accused of fraudulent trading and 5 more counts of fraud between a period of 2015 through 2017 through the CFDs that were occurring here. And the total known loss to these victims is over $8 million. That's where we're at, ladies and gentlemen. These are the kinds of things that we have to deal with in financial markets. These are the kind of brokerages, banks, hedge funds, criminal actors that we are dealing with every single day. Hence, go to litexchange.com. There's no E at the beginning of Lit Exchange, and you can get more information about our upcoming stock broker dealer firm. And you can even sign up for our funding, basically our investment founders campaign, in which you can become a founding member and buy private equity in the company and later on sell it upon our eventual IPO on the New York Stock Exchange. This will be in quite some time, in at least a couple of years. So you have a nice buy and hold opportunity for Lit Exchange pending our future success, which I am very confident of. But this is not financial advice, and this is not an offer to buy, hold, or sell any security of any kind. You can just sign up with your email address here at the bottom, and you can get more information that way as well from our FINRA-approved funding portal. You can see our Regulation D filing on the Securities Exchange Commission website here, linked from our website on the sec.gov filing. So, that being the case, I wish you peace and wealth, my friends. Have a great day. Have a great weekend. Have a great Memorial Day. Cheers. We're going to be filthy fucking rich.